Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Thursday, February 12th, 2026, and we're ready to dig into some fresh insights from yesterday's social media chatter.
That's right, Ethan. Our AI has been busy. We saw a really significant spike in discussions, flagging around 10 different stocks. The overall sentiment out there, well, it's a bit of a mixed bag, indicating a market that requires a good deal of caution, but also some promising pockets of growth.
Absolutely. Let's kick things off with DRS. Now, there was a lot of buzz about a company called GNS and its potential for, an explosive short squeeze, mentioning a possible ASX listing. That's some serious optimism there for future growth.
Hold on, Ethan. That post, while very bullish for GNS, isn't actually about the company our KPIs are tracking, Leonardo DRS Inc. For Leonardo DRS, we're seeing a sky-high debt-to-equity ratio of nearly 18, and insiders have actually been net sellers of over 83,000 shares in the last 6 months. That really contradicts any idea of a clean balance sheet or strong internal confidence.
Ouch. So for Leonardo DRS, then, even with some analysts projecting a 27% upside?
Well, the numbers suggest stay away for Leonardo DRS. The debt and insider selling are major red flags, irrespective of external projections.
All right, noted. Next up, Shopify, Shop. They just crushed their Q4 earnings, beat revenue and EPS estimates, issued strong guidance, and announced a massive $2 billion share buyback. That sounds like a dream for growth investors, Brooke.
On paper, yes, Ethan, but the market didn't agree. Despite the stellar report, the stock dumped sharply after market open. Users were, shall we say, less than thrilled after losing thousands on bullish bets. It has an incredibly high price-to-earnings ratio of 86 and a debt-to-equity of almost 9. Those numbers suggest the market demands perfection, and even great news wasn't enough to satisfy those lofty expectations today.
So the market had other ideas on that one.
Indeed. For Shopify, it's a stay away for now, largely due to that extreme volatility and valuation sensitivity, despite the strong underlying business.
Moving on to a familiar face, Micron Technology, MU. We've seen a lot of bullish sentiment here, with users talking about potential for huge gains and long-term value, even targets of $800 to $2,000. Plus, the news is all about AI data center demand and analyst upgrades.
Yes, the community is definitely hyped, Ethan. And to be fair, Micron has exceptional revenue growth at over 56%, and net insider purchases are a strong 30.54% over the last 6 months. That's real skin in the game. Even with a PE of 35, the AI narrative in those recent analyst upgrades to $450, even $600, suggests there's still significant upside.
So even with a high PE, the growth and insider conviction speak volumes, wouldn't you say?
I would, yes. For Micron, we're calling it a buy. The fundamentals and growth story seem to align.
Excellent. Now, let's talk about Caterpillar, CAT. We've got them trading right near their 52-week high, and Argus just raised their price target to $820. That's a strong vote of confidence for an industrial powerhouse.
It is, Ethan, but the valuation metrics are extremely high. A price-to-earnings ratio of 39.5 and a price-to-book of almost 17. Plus, the debt-to-equity is an eye-watering 203. Even with positive revenue growth, that kind of leverage combined with a stretched valuation at an all-time high makes me nervous.
So despite the analysts' optimism, caution is key?
Absolutely. For Caterpillar, it's a stay away for now. The risks outweigh the immediate upside, especially with those valuation numbers.
All right, let's pivot to the tech giant Microsoft, MSFT. Our data shows repeated bullish call options plays, strong Azure growth forecasts, and their leadership in AI. I mean, they're pouring billions into AI. That's a growth story if I ever heard one. Microsoft's fundamentals are indeed rock solid, Ethan, with a 16.7% revenue growth and an impressive 39% net profit margin. And the insider buying is substantial, over 418,000 net shares purchased. Those are powerful signals of internal confidence. We did see some mixed short-term sentiment in social media, but the long-term outlook is quite compelling. Seems like they're just getting started.
I agree. For Microsoft, it's a clear buy. The growth, profitability, and insider conviction are too strong to ignore.
Excellent. Next, we have ASX, another instance where discussions were about a different company potentially listing on the ASX, which is the Australian Securities Exchange. Right. And for the ASX exchange operator itself, while it's trading near its 52-week high and showing some revenue growth, its PE ratio is over 40 and price to book is 9.4. That's a very rich valuation for a company with a net profit margin of only 6.3%. So a lot of optimism priced in, but maybe not enough raw profit to back it up?
Precisely.
For ASX, we recommend you stay away. The valuation is just too stretched for the current profitability. How about SanDisk, SNDK? We saw some users pounding the table on this as a top semiconductor stock, with calls for double-digit returns and extreme price targets, even $2,000. Plus, insiders are buying. Even despite the hype in insider buying, SanDisk is currently unprofitable, with a negative net profit margin of negative 0.11 and negative EPS. It also has a very high debt-to-equity ratio of almost 8. It's tough to justify that bullish excitement when the company isn't making money and carries that much debt, regardless of impressive revenue growth. That's a tough pill to swallow when the community is so optimistic. It is. But for SanDisk, based on those fundamentals, we have to say stay away. The risk of unprofitability and high debt is simply too high. Next, let's talk about Root Inc., Root. This is an AI insurance company. That's a hot sector. The social chatter is overwhelmingly bearish even. Users are sharing stories of significant losses, calling it the dip that keeps on dipping. It's trading near its 52-week low, and insiders have actually been net sellers. Even with a positive EPS, the market is rejecting this stock hard.
The market can be brutal.
It certainly can. For Root, it's a definitive stay away. The sentiment and the price action are too strong to ignore. Finally, Nebulous Group, Nebulous. The main post was incredibly bullish, predicting it could be the biggest winner of 2026 in AI with huge revenue growth numbers. That was a compelling thesis, Ethan, highlighting incredible revenue growth of 355%. However, our data shows negative EPS and an incredibly high debt-to-equity ratio of almost 95. The comments were also very cautious, with many users predicting an earnings dump given the current market's aversion to unprofitable growth stocks. So lots of potential, but current profitability is an issue. Exactly. For Nebulous Group, we're going to classify it as a stay away for now, especially with the upcoming earnings. The market is just too risk-averse to high-debt, unprofitable growth plays at the moment. Last one today, Carvana, CVNA. Lots of talk about puts here, Brooke.
And for good reason, Ethan. Our data backs up those bearish sentiments. Carvana has an extremely high debt-to-equity ratio of over 192, a very high PE ratio, and insiders have been significant net sellers, offloading over 21% of their holdings in the last 6 months. Users are concerned about them hiding delinquent loans. That's a lot of red flags.
Wow, insider selling that significant is a serious warning sign.
It absolutely is. For Carvana, CVNA, it's a strong stay away. The financial risks and insider sentiment are too concerning.
All right, to wrap things up, here are our candidates for deeper analysis today, based on our AI-generated insights. Investigate as buy, Micron Technology, MU, Microsoft Corporation, MSFT. Investigate as cautious buy, none. Investigate as speculative gamble, Nebulous Group NV.
And that's our market commentary for today. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for tuning in to the Daily Hunt for Multibaggers. We'll be back tomorrow with more AI-powered insights. Happy hunting!